Hi everyone, in this video we'll be going over A-Level Accounting 2023 Specimen Paper 3 question number 3. So paper 3 is going to be quite different from this year onwards. Previously we used to have 6 questions, each of 25 marks, and we were given a time limit of 3 hours. And 4 of those questions related to financial accounting, whereas 2 of those related to cost and management accounting. And from this year onwards, previous paper 3 is being split up into 2 papers, paper 3 and paper 4. And for paper 3, we will only get 3 questions, each of 25 marks, but all 3 of them will only relate to financial accounting in paper 3. And we have the total marks weightage of 75, and we're also given a time limit of 1 hour and 30 minutes, which means that ideally we should be spending 30 minutes for each question. And in this video as well, we will be attempting to solve this question under 30 minutes. So without any further delay, let's get started. Amil and James are in partnership. Their statement of financial position on 1st January 2020 was as follows. Alright. Then M Limited took over the business of the partnership of Amil and James on 1st January 2020. The following information is also available. Okay, let's have a look at the first question. We need to explain the difference between inherent goodwill and purchased goodwill. So inherent goodwill is a goodwill that is gained by the efforts of the business itself, and it is also not included in the financial statements. Let's write it down. Inherent goodwill is gained by the efforts of the business and is not included in the financial statements. But if we talk about purchased goodwill, it is basically the excess of purchase consideration over the fair value of the identifiable net assets on the acquisition of a business. So whenever we purchase any business, the amount or the additional amount that we pay for as compared to the fair value of the net assets, that is basically the purchased goodwill. And it can be included in the financial statements as intangible non-current assets. Let's write it down. Purchased goodwill is the excess of purchase consideration over the fair value of the identifiable net assets on the acquisition of a business. And it is included in the financial statements as intangible non-current assets. Now let's move towards the second part. We need to calculate the amount of the debenture to be issued to James. Let's have a look at the given additional information. Okay, right here we can see there is 6% debenture to cover the loan from James and to ensure his annual interest income remains the same. So this is 6% debenture. And again, we're talking about James' loan right here. M Limited will take over all the remaining assets and liabilities of the partnership with the exception of James' loan and the cash at bank. Okay, I think we're given information regarding James' loan in the above statement of financial position. Right here, we can see that this is 4% loan from James, which is 9,000. And what M Limited is saying is that they will provide or issue 6% debenture to cover loan from James. And the loan from James amounted to 9,000, right? And to ensure his annual interest income remains the same. So let's figure out the interest income for the loan, which was at 4%. So let's figure it out below. We have our interest on loan to be 4% of the loan amount. So that's 4% times the loan amount of 9,000. So that is just 0.04 times 9,000, which results in 360. And now we require the same income as the interest on 6% debenture, right? So what we can write down is 6% times the debenture amount will give our interest of 360. And now we can figure out the debenture amount. So our debenture amount is just going to be 360 divided by 6%, which you can write down as 0.06. And this gives the amount of debenture to be issued to James to have the value of 6,000. Now we can move towards the third question. We need to prepare the journal entry in M Limited's book to record the purchase of the partnership, and a narrative is not required. So let's create the debit side and the credit side. And remember that M Limited is purchasing, and we are writing this journal entry in their book, which means that all of the purchased items will be recorded on the debit side, since there is a rule for journal: debit what comes in and credit what goes out. And the amount that they are going to pay out will be recorded on the credit side. Okay, so let's have a look above. Okay, we're given the values of the assets of Amil and James right here. Let's figure out the total amount of the assets that they took. Okay, the partner did not keep separate current accounts. We have profit sharing ratio. This is asset valuation, and Amil will take a computer valued at 2,500, which means that 2,500 will be reduced from the office equipment taken over by M Limited, right? So that's 14,000 minus 2,500, which results in 11,500. So this is the amount of office equipment that M Limited took over. Then M Limited will take over the remaining assets and liabilities of the partnership. So the remaining assets, that will be inventory at 8,000, trade receivables at 16,000, and they're also going to take over the liabilities. So let's have a look above. We have the current liabilities right here amounting to 14,000. So they're also going to take over this liability, and an increment in the liability should be recorded on the credit side. So we're going to record this amount of 14,000 on the credit side in our journal. Then let's figure out other items to be included in the journal as well. M Limited is issuing a 6% debenture, right? Which means that this amount that we just figured out as 6,000 should be included on the credit side, since this is an increment in our capital and liabilities section, right? Then the company will issue 50,000 ordinary shares of $1 each at a premium of 0.20 per share. Again, this is an increment in capital, which should be recorded on the credit side in our journal entry. Let's figure out the value for ordinary share capital. So ordinary share capital will increase by the number of shares times the nominal rate. In this case, that's 50,000 times 1, which is again 50,000. So this amount should be recorded on the credit side. Then we also have the share premium of 0.20. So the value of share premium is the total number of shares issued, that's 50,000, times the share premium rate of 0.20, which results in the amount of 10,000. All right, then the balance of the sales proceeds will be 20,000 and will be paid into the partnership's bank account. So since we are paying it to the partnership, this is cash out, which should be recorded on the credit side. Okay, so these are all the amounts, and also we need to pay the goodwill, and goodwill is to be recorded on the debit side, since goodwill is basically the purchased goodwill, which is an asset, right? So let's write down the amounts on our debit side. So the debit side is going to include land and buildings, office equipment, inventory, trade receivables, along with the goodwill. Let's write it down. That is land and buildings, office equipment, inventory, trade receivables, and goodwill. Now let's write down the amount for all these headings. For land and buildings, that will be 50,000. For office equipment, 11,500. For inventory, that's 8,000. And for trade receivables, that's 16,000. Let's write it down. That is 50,000, 11,500. Inventory was 8,000. And trade receivables was 16,000. And we're not given the value for goodwill, which means that this will be our balancing figure, which we will figure out at the later period. Now let's move towards the amount or items to be included on the credit side. So the very first one was current liabilities. Then M Limited also issued debentures, and they also issued ordinary shares. So that could be written down as ordinary share capital. Then we also have share premium, since those shares were issued at a premium of 0.25. And finally, they also paid the amount of 20,000. So that we can write down under the heading of bank. Now let's write down the amounts for all these items. Our current liability was of 14,000. Let's write this amount down. So current liabilities is 14,000. Then we issued debentures worth 6,000. Now ordinary share capital and share premium we just figured out above. So we're just going to copy these amounts of 50,000 and 10,000 respectively. And the amount paid into bank was given to be 20,000. Let's write it down. Now, in order to figure out our goodwill value, we know that journal should balance. So the debit side and the credit side should be equal. Let's figure out the total for the credit side. That will be the sum of these five amounts: 14,000 plus 6,000 plus 50,000 plus 10,000 plus 20,000. And it results in 100,000, which should be the balance for debit side as well. Now our goodwill acts as the balancing figure. And in order to figure out the balancing figure, we just need to subtract these amounts from the total. In this case, that's 100,000 minus 50,000 minus 11,500 minus 8,000 minus 16,000, which results in 14,500. That is the value for the goodwill. Now we can move towards the fourth part. We need to prepare the partner's capital accounts to show the closure of the partnership. Alright, so we're preparing capital accounts. And capital account has a debit and the credit side, right? So let's create the format. Okay, and we have two partners. So this is the credit side for Amil and James. And this will be the debit side for Amil and James. We'll start with our opening balance, which is at the date of 1st January 2020. So we can write down our balance brought down. And this amount can be found in our statement of financial position given above. So let's have a look. Okay, right here we have our capital accounts. Amil has the balance of 43,000 and James has the balance of 25,000. Let's write it down. So that's 43,000 for Amil and 25,000 for James. Okay, then in our additional information, we were told that current accounts were not kept. So we do not need to adjust any sort of current account balances in our capital account. But remember that James had a loan of 9,000. And this loan should be adjusted in the credit side in our capital account, since the amount that James should receive is now being increased by 9,000. Let's write it down. So that's loan for James, which was of 9,000. Let's have a look above. The next thing that we need to write down in our capital account will be the profit on realization. And profit on realization is basically the purchase consideration minus the actual net assets purchase value, right? So let's talk about our purchase consideration. And we figured out the debenture value to be 6,000, right? That is a part of purchase consideration. Then we gave out ordinary shares worth 50,000. We also gave out share premium worth 10,000. And we gave out the final amount of 20,000. Right? So this gives our total purchase consideration to be 6,000 plus 50,000 plus 10,000 plus 20,000, which results in 86,000. Now let's figure out the total net assets value taken over. So we took over land and buildings, that's 40,000. Office equipment, that's 16,000. Then we have inventory worth 10,000. Then we have our trade receivables of 19,000. And we also took over the current liability worth 14,000, right? So that's minus 14,000. And one more thing we have to adjust is that the value of the computer that Amil took over, because this is not something to be paid for by M Limited. This is something to be paid for by Amil. So we will reduce this amount of 2,500 as well. That's minus 2,500. Now this results the total value of net assets purchased to be 40,000 plus 16,000 plus 10,000 plus 19,000 minus 14,000 minus 2,500, which results in 68,500. So the profit on realization is going to be purchase consideration minus net assets value, and the purchase consideration we figured it out to be 86,000, and our net assets value is 68,500, which gives our profit on realization to be 17,500. Now we just need to divide it among our two partners, Amil and James, on the basis of their profit sharing ratio, which is 2:3. Let's do it. So profit on realization increases the amount that they should receive, which should be recorded on the credit side. So that's profit on realization. And their profit sharing ratio is 2:3. And we figure out the total profit on realization to be 17,500, which means that the profit on realization for Amil is going to be the total amount of 17,500 times 2 out of 5 parts. So that's 2 by 5, which results in his share of profit on realization to be 7,000. And for James, that will be the total amount of 17,500 times 3 parts out of the 5 parts. So that's 3 by 5, which results in 10,500. Let's write it down. That's 7,000 for Amil and 10,500 for James. Now we need to record all of the amounts that they will receive from M Limited on our debit side. Let's have a look above. As their total shares, they will be getting the amount of 50,000 plus 10,000, right? So total share amount will be 50,000 plus 10,000, which results in 60,000. And we are told that this is to be allocated to Amil and James in their profit sharing ratios. So let's figure it out. The total value is of 60,000. And we're talking about ordinary shares provided by M Limited. So that will be M Limited ordinary shares. Now for Amil, he will get the total of 60,000 times his profit sharing ratio, which is 2 out of 5. And this results in an amount of 24,000. Again, for James, that will be 60,000 times his profit sharing ratio, which is 3 parts out of 5 parts. So that's times 3 by 5, which results in the amount of 36,000. Let's write it down. That will be 24,000 for Amil and 36,000 for James. And we also know that M Limited issued a debenture worth of 6,000 for James, right? So we need to record that as well. That's going to be M Limited 6% debentures, which was worth 6,000 for James. All right, then finally, we have the office equipment taken over by Amil, for which he has to pay the amount of 2,500. This will reduce his capital account balances, and any reduction in capital account balances is to be recorded on the debit side. So we record this on the debit side of the capital account. Let's do that. We have office equipment, which is computer in this case, and the amount worth is 2,500. Okay, let's have a look at the additional information again. We're told that the balance will be paid into the partnership's bank account. So our balancing figure will be bank in the capital account. Let's do that. We have bank as our balancing figure. All right. Now we can just figure out the total from the credit side and then figure out our balancing figure, which is bank in this case. For credit side, the total for Amil will be 43,000 plus 7,000, which results in 50,000. That will be the same for debit side as well. And for James, that will be 25,000 plus 9,000 plus 10,500, which results in 44,500. Again, that will be the same for the debit side as well. Now, in order to figure out the balancing figure, we just need to subtract these amounts from total. For Amil, that will be 50,000 minus 24,000 minus 2,500, which results in 23,500. And for James, that will be 44,500 minus 36,000 minus 6,000, which results in 2,500. Okay, this concludes the partner's capital accounts to show the closure of the partnership. Now we can move towards the fifth part. We need to prepare the partnership bank account recording the closure of the partnership. Okay, let's prepare our bank account. This is going to have the debit side and the credit side. Okay. So debit side will record all of the inflows, whereas credit side will record all of the outflows. Now let's have a look at our opening balance, which is given in the statement of financial position. Okay, cash at bank is given to be 6,000. So this will be our opening balance, which will be recorded on the debit side in our bank account. Let's do that. So that's balance brought down of 6,000. Then we were also told that M Limited paid 20,000 into the partnership's bank account. Right here, we're told that the balance of the sales proceeds will be 20,000 and will be paid into the partnership's bank account, which means that this amount of 20,000 will increase our bank account balance, which should be recorded on the debit side. Let's do that. So that will be M Limited with the amount of 20,000. Then since the bank account of the partnership is now closing, since partnership was purchased by M Limited, we need to settle these amounts. And this settlement is made through distribution to the capital account balances for Amil and Jamal. We paid out 23,500 to Amil and 2,500 to James. Let's write it down. So that will be our capital balances. For Amil, we paid 23,500, and for James, we paid 2,500. Now let's see if our bank account balances. For the debit side, that's 6,000 plus 20,000, which results in 26,000. And for the credit side, that will be 23,500 plus 2,500, which again results in 26,000. So our bank account is balanced, which means that our capital account balancing figure as well as this bank account is correct. Now we can move towards the sixth part. We now need to discuss the advantages and disadvantages of the decision of directors of M Limited to purchase the partnership. Let's talk about advantage first. So the very first thing is that M Limited purchased a partnership which is a rival, right? And by purchasing that rival, they have basically eliminated the competition. That is a major advantage. Let's write it down. They have now eliminated a rival. Okay, and by eliminating it and by purchasing the partnership, they also gained their list of customers to widen their customer base. So that also acts as a major advantage. Let's write it down. They have gained their list of customers to widen their customer base. And by widening their customer base, it could lead to greater sales revenue as well as higher profit. Let's write it down. Could lead to greater sales revenue and higher profit. Okay, now we can move towards discussing our disadvantages. Okay, I forgot to write down the heading. You should mention the advantages and disadvantages clearly. The major disadvantage would be dilution of ownership, since now the company M Limited issued shares to both Amil and James, right? Let's write it down. There is a dilution of ownership since new shares have been issued Then there is also a risk of old customers of the partnership not going to the new business. That could act as a disadvantage. Let's write it down. Old customers of the partnership may not go to new business. All right. So this concludes the third question for 2023 Specimen Paper 3. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.